Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello and welcome to another episode of On My Way to Wealth. My name is Luis Rosa and I'm your host. Thank you very much for tuning in today. I want to talk to you today about the Roth IRA versus a traditional IRA, what they mean, how to take advantage of both, and see which one is better for you. Before we get into that, I just want to let you know that before you consider investing or contributing to an IRA or traditional IRA, if you are an employee and your employer offers a 401k, definitely look into the plan document first to see if your employer offers a match. And the reason I say that is because some plans will typically match dollar for dollar or 50 cents on a dollar up to a certain percentage of your basic pay. So you do not want to leave that free money on the table. So if you are in a job that offers a 401k and they do offer a match, before you start investing elsewhere, find out what that match is and maybe contribute at least up to that amount. So if you are putting in 3% of your base pay and your employer is also putting in 3% of your base pay, that's a pretty good return on your money, right? Because you're getting free money from your employer. So look into that first before you get into whether or not you should do Roth or traditional. Now, that being said, let me tell you about the Roth IRA first. The Roth IRA, it's actually not that old. You hardly ever hear people talking about it, but it hasn't been here forever. It was part of the Taxpayer Relief Act of 1997. And the champion of this was a senator from Delaware by the name of William Victor Roth. So shout outs to Senator William Victor Roth because he gave us the Roth IRA, which will forever bear his name. Before I tell you about the details between the Roth IRA and the traditional IRA, I wanted to make sure that I mentioned where it came from, right? So there you have it, folks. Senator from Delaware who was an Army veteran, 1997, as part of the Taxpayer Relief Act, William Victor Roth. Now, that being said, when you are going to save money for retirement, if you're not doing it through your employer, like a 401k, you have options outside of that, or in addition to, rather, where you can save on either a pre-tax or a post-tax basis. And this is really at the core of the difference between a Roth IRA and a traditional IRA. So let me put it to you this way. Think of yourself as if you were a farmer. Would you want to pay taxes on your seed, or would you rather pay taxes on the harvest? In this case, the seed is your contribution. The harvest is the growth of that contribution over time. So when you save for retirement, you're going to pay taxes. You're going to pay taxes either today at your current tax bracket, or you're going to pay taxes tomorrow at your tax bracket then. And this is the question here, to Roth or not to Roth. Kind of makes me feel like I'm back in high school with to be or not to be. That is the question. But basically, for the people who choose to do traditional, and this could be either in an IRA or the traditional 401k that we all have come to know, or your retirement plan at work, 403b, 457, it's basically the concept of, well, whatever money I contribute to a traditional retirement account today, I don't pay taxes on today. And the idea behind that is I can lower my taxable income today and then defer the taxation on that money and its growth for later on when I'm older and retired and supposedly or hopefully in a lower tax bracket. So let me give you an example. Right now, the limit to contribute to a 401k, if you're under the age of 50, is $19,500. So imagine somebody made $80,000 a year and they're able to put $10,000 into their 401k. That means that the IRS is only going to tax you today on $70,000 because that $10,000 contribution is being done on a pre-tax basis. As soon as you get paid, it immediately goes into your 401k. The IRS doesn't tax you on it. Now, on the back end of that, That $10,000, let's say you invested inside your 401k based on the available funds in your particular plan, that money is going to compound over time. And eventually, you're going to have a larger sum of money than what you contributed over the years because of compound interest. You will then start taking distributions from that account and pay taxes as ordinary income at that point. Now, what a lot of people do is they feel like, well, they might be in a higher tax bracket today than they expect to be in later when they retire. So they'd rather get a tax deduction today by putting pre-tax money into these investment vehicles and then paying less taxes later when they're retired. Now, that may or may not be the case. I can tell you from experience that I have clients that are retired who are not in a lower tax bracket today than they were before because they have several sources of income, and that could be pensions, Social Security, distributions from 401k, IRAs, rental income, et cetera, et cetera. So it's something that you definitely want to sit down with a financial planner and go over to see if it makes sense for you based on your situation and will you think you'll be in the future, whether or not it makes sense to do now or later. If you take money out before the age of 59 and a half from these traditional plans, you will pay the income taxes that you're supposed to pay plus an additional 10% penalty. And there are some exceptions to that 10% penalty. But for the most part, if you take money out of an IRA before age 59 and a half, you're going to pay income tax plus a 10% penalty. If you wait until after age 59 and a half, then you only pay the taxes on that. Now, the Roth IRA is the flip side to that, where you contribute money on a post-tax basis and you do not get any type of tax benefit today for having contributed to a Roth IRA. So in other words, in the scenario that I gave, if you make $80,000 a year, and let's say your employer offers a Roth 401k option, which is now becoming more and more common, you can contribute $10,000 to your Roth 401k, and you are still going to get taxed on the entire $80,000. So your taxable income will not decrease today as a result of the contribution to either your Roth IRA or a Roth 401k. Now, that being said, the opposite end of that is that the contribution that you made, if you keep it for a minimum of 5 years and wait until at least age 59 and a half, all that money and its growth is going to be tax-free income. And it's not a typo. You did hear that right. Tax-free income if you follow those rules. So now you have to think, going back to your farmer mentality, do we want to pay taxes on the seed or do we want to pay taxes on the harvest? And this is a great planning opportunity for people because you can decide whether or not it makes more sense to pay taxes today or later based on your tax bracket, your current situation, and where you're going in terms of your income in the future. So let me tell you what some of the limits are for contributions. If you are investing or contributing to a 401k, 403b, 457, your retirement plan at work, the maximum contribution is $19,500 if you're under the age of 50. This is per year. And it doesn't matter. Same limits apply whether it's a Roth 401k or a traditional 401k. And if you're over the age of 50 and older, you have an additional $6,500 catch-up contribution. So in essence, you can contribute $26,000 per year into your retirement plan through your employer. And there are no income limits to that. So it doesn't matter how much money you make, you can still choose to max out those plans if you can and choose to. And that is separate from any employer match that you might get. So you yourself could do the max of $19,500, and then the employer can still match you a certain percentage on top of that, up to some limits. But overall, your own employee contribution is maxed at the $19,500 or the $26,000 if you over age 50 or older. Now, you also have an option to contribute money to an IRA outside of your 401k that you get on your own through the company of your choice. And you can still max out $6,000 for a Roth IRA or traditional IRA. And if you're age 50 or older, there's an additional $1,000 catch-up contribution for a total of $7,000. Now, there are some income limits to take into consideration. Let me tell you what some of those are. They've gone up slightly from 2019 to 2020. It depends on your filing status, and it also depends on your income. So let me give you an example for a Roth IRA in 2020. If you're single and you make less than $124,000, this is your modified adjusted gross income, you can contribute the full $6,000 amount to a Roth IRA. So even though there's no tax benefit today, the IRS still puts income limits on you because they don't want people who have a lot of money to just put a ton of money into a Roth and just never pay taxes on it, or pay a little tax on it today and then never pay taxes on it ever again. So you do have some limits, $6,000 if you're under the age of 50. If you are single and make over 124 but less than 139, you can do a partial contribution to your Roth IRA. And if you make over the $139,000, then you are not eligible to contribute to a Roth. And I'm going to tell you a little bit about how you can circumvent that later. If you're married filing joint, the limit is less than $196,000. You can contribute $6,000 each into that account. And one cool thing about this is if you are a married couple and one of you does not work, as long as one of you made enough income to contribute, you can both contribute $6,000 each or $7,000 each if you're over the age of 50. So even if one spouse did not work, as long as one of them did, you can both contribute. It's called the spousal IRA, which is a great feature. If you make between 196 and 206,000, you can make a partial contribution as a married couple. And if you make over 206,000, and this is the modified adjusted gross income, then you're not eligible to contribute. And then married filing separate is a whole nother ballgame, but technically you are not eligible if you make more than $10,000 and you file in married filing separate. So this is very important too from a planning perspective. If you are thinking about doing married filing separate for some reason, make sure you speak to your financial planner or your CPA to make sure that that is making sense for you overall, because then you're going to be limited. Less than $10,000, you can still contribute a partial contribution to a Roth, but if you make over 10, you're not going to be eligible at all. So something really important to keep in mind. Now, what about a traditional IRA? The income limits are different for traditional IRA because you do get a tax deduction today. So the same contribution limits apply, $6,000 for 2019 and 2020 for under age 50, and $7,000, which include that $1,000 catch-up contribution, age 50 or older. But there are some income limit variations when it comes to that. So to give you an example, in 2020, if you're a single individual and you make less than $65,000, your modified adjusted gross income, you can get a full deduction up to the amount of your contribution limit, which is the $6,000. If you make between $65,000 and $75,000, you could do a partial contribution. If you make over $75,000, then there is no deduction. Married filing joint returns. If you make less than $104,000, you can get a full deduction up to the amount of your contribution limit. If you make between $104,000 and $124,000, partial deduction. Over $124,000, no deduction. And if you're married filing separate, less than $10,000, you get a partial deduction. Over $10,000, then you get no deduction. Now, there's something else that comes into play. This is if you were covered by a retirement plan at work, that you have those income limits. If you are not covered by a retirement plan at work, then it doesn't matter. You can contribute up to the contribution limit regardless of your income and still get that full deduction. So it depends on marital status, how much you make, so this is really important that you speak to your financial planner or your CPA about to make sure that you're doing what's right for you. So which way is best, right? So it just matters on your current situation and your preference. I know clients who are married, filing joint, they are in a high income tax bracket, and they both just max out their 401ks and contribute to IRAs just to lower the taxable income today because they feel like they're not going to be in such a high tax bracket when they retire later. And that's completely fine because that is there for you to take advantage of. That's what the whole thing of the tax code is. You don't have to pay extra taxes if you have a legal way of going about it, right? So that's one of the ways you can do it, is contributing to your traditional IRA or 401k. Now, I have other couples that would rather pay taxes today and not pay taxes later, and they choose to do the Roth option. And it's a great strategy. I always tell people, especially if you're young and you're just starting to work now, I have clients that are young that after their deductions and everything, they're in the 12% tax bracket, maybe 22% tax bracket. So I'm like, let's do the Roth because you're going to just keep making more money as time goes by. Also, the current tax brackets are in effect until December 31st, 2025. That's when the Tax Cuts and Jobs Act is scheduled to sunset. And yeah, it could be extended. But when you look at the level of debt that we already had, this is pre-COVID-19, the trillions of dollars of debt. Post-COVID-19 with the CARES Act and stimulus, and maybe even more stimulus coming, we are just printing money. And the United States has to, at some point, start making that money back. And one of the most efficient ways that the government can make money back is taxing its citizens, right? So when I look at it from that standpoint, I feel like tax brackets are going to go back up at some point in the future so that the government can get that money back. So the Roth IRA comes into play. You're, in essence, locking in your contributions by contributing now, because then you're paying on the contribution based on that tax bracket. Now, there are other benefits to the Roth IRA. Right now, under the Secure Act, if you're over the age of 72 and up, you're required to start taking a minimum distribution. Before the Secure Act, on your traditional IRA, before the Secure Act, it was age 70 and a half. So there are people out there who are taking requirement minimum distributions that they might not even need, but because they happen to be either in a 401k or a traditional IRA, they are required by the government based on a life expectancy table to start taking RMDs. Now, it doesn't apply this year because the CARES Act postponed them. But for the most part, aside from that, you'd have to start taking requirement minimum distributions at some point and then start paying taxes on that money. A Roth IRA does not have minimum requirements for require minimum distributions. They're known as RMDs for short, which is great because that means that you can have your Roth past 70 and a half, past 72, and you don't have to worry about touching it if you don't need that money. The other beautiful thing about the Roth is that because it is not considered income, it doesn't affect the taxability of your Social Security benefits. This is something that a lot of people seem to be surprised about because they have a misconception that Social Security benefits are not taxable. For most people who live on Social Security alone, that is true. They just get their Social Security and they don't pay taxes. However, there is a formula where if you start earning money, whether it's from a job or from a distribution from a 401k or a traditional IRA, that is considered taxable income. And then it might trigger taxation of your Social Security benefits. So there are people out there who are now paying taxes on part of those Social Security benefits because they are taking money out of the IRA and 401k accounts. And sometimes it's just the required minimum distribution that's causing that. So when you do a Roth, you don't have to worry about that because the money coming out later, if you hold it for 5 years and wait until age 59 and a half, is going to be all tax-free. And then you don't have to worry about that triggering taxation on Social Security. So that's a great planning strategy. Another thing to consider with the Roth is that the money that you contributed already went in there pre-tax. So let's say if you had some sort of emergency and you had to tap into it and you had to take some money out, as long as that money that you're taking out is considered part of your initial contribution, you're not going to pay taxes on it. You only pay the 10% penalty in income tax on the earnings on that money if you take it out before the age of 59 and a half, because you're not going to get taxed twice on the contribution. So that's something else to consider. And if you did have to take money out, there is a one-time 60-day window for every 12-month period where you can roll money back in to either a Roth or a traditional to kind of like basically undo the taxation of that distribution. So another great feature of the Roth. Now, I mentioned earlier that there is a way to circumvent those income limits. This is probably the topic for another podcast because it's very detailed and perhaps cumbersome, but I wanted to at least mention it. And that is considered a Roth conversion. in essence, what you do is you take money from a traditional IRA or 401k and you can convert it into a Roth IRA. And in essence, you are going to pay income taxes on that conversion, but you're not paying the 10% penalty for the conversion, which is a great feature. So a lot of you that probably switch jobs and you have an old 401k somewhere, it's a good strategy sometimes for you to just convert that into a Roth. You don't have to do it all at once, which is great, but you can then slowly kind of like undo what you did in the past and basically pay taxes on it. It could be a great planning strategy. You know, a lot of you might be in a lower bracket this year because of COVID-19. Maybe your income went down. So you might consider that. Let's say that your income went down. You went down in tax bracket and then you get your job back or you get back to full pay. But a few months went by without being employed or being underpaid. You might want to consider doing a Roth conversion if you have a traditional IRA or traditional 401k somewhere and pay taxes today on that conversion on a lower bracket. So it's a great planning tool. So definitely speak to your financial planner about that. And the last thing I want to say is the contribution deadline for both traditional and Roth IRAs is the tax deadline, typically April 15th. Now, this year in 2020, the deadline is July 15th. So as of the time of the recording of this podcast, the deadline is still July 15th. If that hasn't changed, you'll be listening to the episode on July 15th. So you still have a chance to contribute towards tax year 2019 for a Roth IRA or a traditional IRA. So if you have that opportunity and you think it's good for you, you can still go online, open an IRA, and contribute towards tax year 2019. So that is pretty much in a nutshell everything about the Roth and the traditional. We talked about the income limits, the contribution limits, the difference between traditional and a Roth. A lot of employers offering Roth 401ks, which is great because if you think about it, on the outside, a Roth IRA has a $6,000 contribution limit if you're under the age of 50. But on a Roth 401k, you could do more than 3 times as much, $19,500 with no income limits. And on top of that, you can still do the $6,000 limit if you're under the income limits on top of that. So if you're a high earner, this could be a great strategy for you. So think about those options as far as taxation, whether you want to pay now or later, or if it makes sense to do a Roth IRA contribution for you. So thank you very much for tuning in. I want you guys to keep sending me questions. This is great. A lot of the topics that I'm coming up with is because you have been reaching out, sending me emails and telling me, hey, why don't you do an episode about this? Which is great. So keep them coming. If you have somebody that you'd like for me to interview that you know you want to make that introduction, feel free to send me that email as well. It's luis@onmywaytowealth.com. And if you want to read this, I'm also doing a blog every week to correspond with the podcast. So you can go to onmywaytowealth.com and actually read the blog itself. If you want to just listen to it, same thing. You can go to onmywaytowealth.com or listen to it on your favorite podcasting platforms. So thank you very much for tuning in. I hope you enjoyed it, learned something. I'll see you on the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.